Target is facing some major backlash after deciding to pull some Pride items from shelves.
Target says that last year it lost hundreds of millions of dollars from theft.
Target is the latest company making changes following backlash over its LGBTQ+ support.
Target is pulling some LGBTQ+ merchandise from stores that it rolled out for Pride Month after confrontations with some customers.
For a retail company, it is crucial always to have your customers satisfied. Controversial branding may completely ruin the company, and Target is a perfect example. Given the horrendous condition of the retail sector in America, Target is now on the verge of collapse. In this video, we'll explore 10 reasons why Target is doomed. But before moving to the first point of the list, consider subscribing to the channel and hitting the notification bell. That way, you'll never miss future uploads. 1. Astronomical losses. Target's market cap has fallen over $15.7 billion in 1 month. In June, a Bloomberg analysis revealed that Target Corp had lost nearly $13 billion in market value since announcing its earnings last month. Many on Wall Street predict further challenges for the retailer. Despite initially rising after releasing mixed results, the stock has experienced its most extended consecutive period of daily losses since February 2000, falling for 9 days straight until May 31st. According to analysts tracked by Bloomberg in June, Target had 22 buy ratings, 17 holds, and no sells. Although the average analyst share price Target predicts a return potential of over 30% for the next year, at $177, this is still significantly lower than Target's record high of $266.39 in November 2021. According to recent Google Finance data, Target's share fell to $131 from $181 in February. Such losses are extremely dangerous for a company's financial health, especially when the whole retail sector struggles. Number 2, investors flee the company. Target is facing financial problems as investors sell off their shares, which suggests a lack of confidence in the company's financial performance. This selling pressure is putting additional strain on Target's financial stability and contributing to its ongoing struggles. The American Conservative Values ETF announced Thursday that it had divested its holdings in the retail giant and added the company to its refuse to buy list, citing the company's woke agenda. Number 3, consumer outrage. Target is facing a decline in popularity and customer loyalty due to consumers rejecting its products. This can result in a loss of potential revenue, which is a significant issue for any retailer. Recently, conservatives and moderates have been boycotting Target due to the company selling clothes with LGBTQ-friendly slogans. Some people have accused the company of grooming children, which has led to several stores in the rural South hiding and toning down the Pride sections. Target headquarters staff members reportedly held an emergency meeting to avoid a situation similar to a Bud Light situation. Number 4, Target's executives are alarmed by the looming possibility of store closures, increased prices, and reduced profits. Their concern stems from the adverse effects that such measures can have on the business. Although they are often resorted to out of sheer desperation to improve financial performance, these outcomes are not to be taken lightly. The executives are aware of the gravity of the situation. For instance, Target has officially acknowledged retail theft as one of the threats to the company. Like other retailers, organized retail crime is a concern across our business. We're taking proactive measures to keep our teams and guests safe while deterring and preventing theft. Spokesperson said, these mitigation efforts include hiring additional security guards, adding third-party guard services at select locations, and using new technologies and tools to protect merchandise from being stolen, Target spokesperson said. Number 5, Target is facing significant peril and is at serious risk of becoming the next victim of the retail collapse, according to experts. The analysis indicates that the company's financial situation is critical and it may face tremendous difficulties in recovering in the current retail environment. KeyBank Capital Markets has cut the retailer's shares to sector weight from overweight due to the resumption of student loan payments stipulated by Congress' debt ceiling agreement. This poses a significant challenge for shoppers' discretionary spending, particularly for a retailer with an elevated discretionary sales mix and a younger, college-educated core consumer demographic. It's important to note that controversial policies with immediate repercussions on the business only compound this issue further. Number 6. Fast stock devaluation. Target's stock price has been consistently declining for 10 consecutive days. This trend indicates a lack of investor confidence and suggests that the company's financial performance is not meeting expectations. Target faced significant backlash for its Pride-themed merchandise, particularly an LGBTQ-focused clothing campaign featuring tuck-friendly bathing suits and pro-trans t-shirts for kids. This controversy has resulted in a massive loss for the company, with a market capitalization drop of over $10 billion in just 10 days. Prior to the backlash, Target shares were valued at $160.96, giving the retailer a market valuation of roughly $74.3 billion. Number 7. Downgrade stock. JP Morgan, a prominent financial institution, downgraded Target stock, which had a negative impact on investor sentiment. This downgrade further erodes investor confidence in the company and may contribute to the decline of its stock price. At the beginning of June, the bank downgraded the retailer's stock to neutral from overweight in a Thursday note, as it highlighted the host of challenges Target's facing. JP Morgan also slashed its price target to $144 from $182. We continue to believe that the consumer is broadly weakening while the share of wallet shift away from goods. Target's been given back market share on a one-year view. We believe this share loss could accelerate into back to school and linger into holiday given consumer pressures and a recent company controversy, as JP Morgan said. Number 8. Controversial branding. Target faced significant backlash and even threats due to the controversy surrounding its new Pride collection. This situation serves as a stark reminder of the potential risk companies run when they take political or social stances and the negative impact it can have on their reputation and financial performance. Due to the severe situation, Target was forced to remove certain Pride-themed merchandise. The company acknowledged the damaging displays and threatening behavior by opponents and issued a statement stating that they're making adjustments to their plans. This includes the removal of items that have been at the center of the most significant controversial behavior. However, Target is now facing criticism from both sides. Number 9. Target's stock collapse is not just a result of the controversy surrounding the Pride collection. Its ongoing challenges and the weakening economy have also significantly contributed to the company's declining stock performance. Major chains such as Target and Home Depot are facing a decline in shoppers due to increased prices and borrowing costs. Despite a slight rise in total sales at Target during the latest quarter, digital sales have fallen as customers curtail their discretionary purchases amidst what CEO Brian Cornell has described as a very challenging environment for consumers. Sales at Target stores have been open for at least 1 year, increased by only 0.7%, with customers spending more on food and essential items. The quarter also saw a 5.8% drop in profits. Target has reported that sales of clothing, home goods, and other discretionary categories have decreased by up to low double digits, while food and beverage sales have increased by high single digits. And number 10, uncertain future. Target's financial outlook is grim as it is projected to suffer a profit loss exceeding $1 billion by year end. This dismal forecast is attributable to several factors, including inventory shrinkage, loss of sales due to stolen goods, as well as an impending consumer recession. These obstacles indicate that Target's financial struggles are likely to persist for the foreseeable future. The first quarter operating income of the company surpassed expectations by 5.2%. This is primarily possible due to the gross margin upside from lower freight and transportation costs and efficiency efforts that have balanced out the higher than anticipated impact from the shrink. However, it's important to note that shrink still decreased the company's gross margin rate by a whole percentage point in the first quarter compared to a year ago, as confirmed by Michael Fidelic, Target's chief financial officer. It's alarming to realize that Target encountered a profit reduction of $700 million last year from inventory shrinkage. This implies that the company is on course to lose $1.2 billion from shrinking in a 2-year period if there are no changes in current trends. Thanks for watching. Hit the like button if you enjoyed the video and let us know what you think about the issue in the comment section below.